All right. Wrapping up chapter 10 today. Learning objective 3 is our starting point. This introduces you to something called responsibility accounting. And it actually is quite important concept overall, because basically it's a way to make management responsible for the numbers that are in their particular departments or divisions uh, or whatnot. And so it's very, very important to sort of understand that. You're also going to learn about something called a cost center and a profit center, and there's some differences to each of those, but they're held to different levels of responsibility of what's in their control, what's not in their control. But basically, it's an interesting concept. So there are various levels of responsibility to help a firm control their costs. Okay. So a department manager, as you see here, is certainly responsible for controlling costs within that person's department. Okay. That's a small portion of a large company, for example. Then you have perhaps someone who's in charge of many different departments, like a division manager. They're responsible for controlling all the costs within that division. Some divisions can be quite huge. All those divisions are made up of various departments, right? And then, of course, the head of the company here, what they dubbed the big cheese. Maybe they're out of Wisconsin or something. Just got back from a football game, not sure. But here they are responsible for the entire company costs, because obviously they are going to be responsible to the board of directors and the stockholders ultimately. So we're looking at who's responsible for what costs and what can they control and what can they actually control. Some costs it's hard to control. Other costs are well within your ability to control. And so that's what responsibility accounting is supposed to help with. So everything is broken into responsibility centers. You'll learn very soon, there are 3 types of responsibility centers: a cost center, a profit center, an investment center. You'll look at those in a moment. But basically, you have to look at those responsibility centers as there are managers or management that's responsible for everything that happens in that responsibility center. There, and again, it can be any level of management that's affected, but this is really, really valuable when you actually have a decentralized company, which means you let managers at the much lower levels have the authority to make decisions that have impacts on revenues and expenses, basically. And so in a decentralized company, everyone sort of has, many managers actually take part in the entire process of decision making. That's not true for a centralized company. A centralized company is very top down, so everything comes from top management down. And so they wouldn't have a lot of responsibility centers here, because they've decided they're taking all the responsibility. Okay. All right. So one of the things that's interesting when we look at responsibility accounting is they actually look at things that they feel are controllable versus not controllable by the manager in charge of that department or that division or even the company. So they distinguish between costs that can be controlled and costs that are not able to be controlled. Okay. And then another huge difference is managers are often evaluated on simply the items they can control. Okay. That's part of their overall performance evaluation. Okay. And this is important. This is very important because for a lot of managers, how they manage either their costs or their revenues and expenses really means staying a manager, getting promoted, having promotion opportunities, or potentially even losing your job because you're not doing a very, very good job. Okay. And believe it or not, both for-profit and nonprofit entities would benefit a great deal and do have responsibility accounting. Okay. Okay. So again, the critical issue that you're introduced to at this is this cost or this revenue in your department, in your particular area, what they call a segment, is it controllable or not? Is it controllable or not? So that is, does a manager really have control over the costs? That's a controllable costs. If it's a controllable cost, the manager will be responsible for it. So responsibility accounting really is about that type of an issue. Certainly all the costs are controllable by top management. Okay. There are just a few exceptions to that. But all the costs are really uh, top management. But as you move down the levels of managerial responsibility, it sort of narrows down to costs that can be controlled. All right. For lower level managers, mid and lower level managers, there are certain costs that are not controlled. Those are called non-controllable costs. And they're not judged on that. They're not judged on that. Okay. So again, we're still looking at what the budget looks like versus what the actual results are. So all of this is still based on what we learned earlier in this chapter. Okay. And of course, it looks at both behavioral issues and reporting issues that management is responsible for. This is often called management by exception. And what they mean by that is that they're looking at the exceptions. You know, what are the differences between what we budgeted and what actually came in? What's that exception? It usually depends on the difference there. So it's got to be quite material. It's got to have a big impact, an amount that's sizable, not something that's really, really small. And then did the manager actually have control over the costs or the revenue of that particular item? And so management by exception really looks at, top management is looking at it and saying, these are the differences. And that's the exception, are the differences. Did the manager have any control over that? Well, how big is the difference? If it's a small difference, we might not care. If it's a big difference, we might care a lot, depending on what way it goes. Is it a favorable difference or an unfavorable difference? Either way, I want to know why, right? That's the exception. And secondly is, could the manager have controlled it better? Is it something that was in the manager's responsibility to control and they didn't do it? If so, that's going to be held as a standard of performance that could either hurt or help the manager, depending. Okay, your book also sort of explains these behavioral principles. Um, Again, all the managers that are going to be held to this level of responsibility center should definitely have direct input into everything regarding their budget goals. If they're going to be responsible for, if you're going to be, if your performance is based on this, you should pretty much have input on all of that. You should have, if you're going to be told that you have to control certain things, you got to have input. So you can tell them, what, this is what I can control, this is what I can't control. That all has to be done as part of the budgeting process when you're making up your budgets. Um, the evaluation is on the behavior of what can be controlled. Okay, so entirely on what can be controlled. How did the manager behave to make that happen or didn't happen? Okay, that's going to be how managers are going to be performed here on their behavior. Um, Upper management needs to support this entire process. They of course have to be reasonable, but the support is definitely in this case top down. It matters. If there are exceptions, the manager has to be able to, you have to give the manager a chance to explain what happened to cause this exception. Okay, this is why we were over budget with labor because blah, blah, blah. So they have to be able to respond. Okay. And of course, because there's a lot of areas, there's going to be both good and poor performance measures that should be identified. The evaluation should not be, oh, you did everything was great, everything was bad. It's these areas were really good. This area was not so good. You know, it has to be balanced in that way. Okay. In terms of the principles of reporting that are listed here, again, it should just contain data that's controlled by the manager. It's no need to add all the other numbers that the manager really has no control over because they're not responsible for that. Particularly again at the lower levels, mid and lower levels. They're not responsible for rent or depreciation. That's all well out of their responsibility levels. They can't control that, but they can control things like direct materials, use of labor, things along these lines, um, keeping the variable costs under control. They don't have a lot of they don't have a lot of say in the fixed area. They might have some. There might be some areas that could be affected, but for the most part, it's overwhelmingly in the variable costs. You've got to make sure you have reliable budget data so you can measure the performance based on appropriate data. You always have to highlight any differences. They have to be explained as best as possible. You have to make these specific for the department or for the division, for whatever it is that you're doing. It should be tailor-made for that evaluation and for that level of management. And you need to keep doing this at reasonable intervals of time, quarterly, semi-annually, annually, what have you. Okay. So let's keep moving on. Obviously, responsibility reporting should happen at every level of the company's organizational chart. Okay. It always starts with lower level, so like departmental managers, and then it moves upward to say division managers, and it moves upward then to upper management, et cetera. So this is a bottoms up sort of report. Again, it has to be management by exception at every level. So basically, what were the changes? This is what we budgeted. This has actually happened. Boy, this is a big difference. Why? What was that exception about? Tell me about. Explain this exception. Whether it's positive or favorable or unfavorable for the company, still has to be explained. Okay. And then, of course, every level of management gets more and more of a detailed report on what's happening. You're going to be seeing that in the book and here. Okay, so here is the levels that we're talking about. This is just a partial organizational chart. If you're in your book, this is page 426. Believe it or not, that's a 4. It doesn't look like a 4, does it? See if I can fix it. Okay, page 426. And again, it's a bottoms up type of situation here for responsibility reporting. So the very first reports would be from the specific departments. And so we have a fabricating department, we have an assembly department, we have an enameling department. Each of these departments would have responsibility reports for the manager of the fabricating department, for the manager of the assembly department, et cetera. These would be prepared, the exceptions would be noted, explained, et cetera, and then it would go up to that next level. In this case, they're giving you a plant manager. So in this case, it's going to be the Chicago plant. All of these departments are from the Chicago plant. Of course, the Detroit plant has the same And the St. Louis plant has the same departments as well, but this is focused on the Chicago plant. Manager would see how all of these departments are functioning within the plant, note anything that could be controlled, note those differences, etc. That report then gets funneled up to the vice president who oversees these plants. Okay, so maybe the vice president of operations or vice president of manufacturing or what have you. Then this vice president would see all the data from each and every plant and each and every department, because that would all be part. So it's a more detailed report by the time it gets up here. Of course, there are other vice presidents, maybe in charge of, administrative and marketing type of thing, selling administrative, maybe another in charge of other areas of the company. All of those reports would be prepared and submitted up. So the president of the company would see all of the data from the vice president. So it's really a bottoms up um, responsibility accounting, and this type of reporting is sort of bottom up. So again, more and more detail as it goes up the ladder. So what does it look like? Well, if you look here, and I'm sorry that this is super duper small, this is on page 427. For those of you that have a book handy, page 427 in your book, you'll see here that report D is specific to the fabricating department manager. Okay. And as you see, that manager has certain controllable costs that that manager was responsible for in the fabricating department. This is what their budget was for each of those costs. This is what actually happened with each of those costs in that period. Here are the exceptions. As you see, it was $1,300 unfavorable. In this case, the actual amount of cost, it's unfavorable because it cost more than what they budgeted for. Okay, they were only expecting to have $84,000 of cost. They had 85,300. That's $1,300 more than they expected. That's why it's unfavorable. Okay. So every department, as you see, this is fabricating, you'd have the other departments creating their own. That would then go up to the plant manager. The plant manager would see the large picture. This is the plant manager from Chicago, right? Just to follow our previous diagram. Here, the fabricating department is reporting with the enameling department as well as the assembly department. The entire plant is reporting to this person. This was the budgeted amount for the costs of each of these departments right here. This was the actual amount that came out during that time period for fabricating, enameling, and assembly, and the total here. So in this case, they were expecting the plant would use 304,000 of total costs between all their departments. They actually used $309,300 of costs. That was $5,300 more, which is why it's an unfavorable report in this case. It's an unfavorable variance or difference. So in this case, it costs more money to run the Chicago plant than had been budgeted. So then the plant manager here will submit this up to the vice president who oversees all of production in this case. So the production plants are in Detroit and Chicago and St. Louis. This was the budgeted amount for each of these units. This was the actual costs that came in from each. As you see, they were expecting to spend on all production 1,179,000 on all the production at all their assembly plants. They ended up spending a little bit more than that, 1,186,300. That's $7,300 more than they had budgeted for, which is why it's an unfavorable variance. All of these would have to be, again, this would have to be explained by the department. This would have to be explained by the plant manager. This would have to be explained by the vice president as it goes up to the president. As you see, as the president of the entire company, they're looking at all of the reports from all of their areas. So the sales report, sales areas here, production, and finance. So here's your production report showing up right here in line 8, along with the sales department and along with their finance department, as you see, looking at the costs. This is, again, not just costs in general, not total costs, what they call controllable costs. So controllable costs are what was in the management's ability to control at the department, at the plant, within the division. And then here's the overall company view. Overall, they had an unfavorable of $11,800. So their costs, their controllable costs, were not controlled as much as they wanted them to be, because they were $11,800 over what they expected to spend. So that has to be explained. So it's just a little bit of each. Moving up. Okay. So this is basically responsibility reporting. What it would look like in terms of all the reports. And as you see, it's a bigger and bigger picture as it moves up. Okay, so from the department to the plant to the division to the whole company in this case. Oh, it actually had slides that were bigger, and here I was squinting. I don't wear glasses for nothing, folks. But I was squinting here. But I just explained all this stuff. Now you can just see a little bit bigger. I might even have to step back from my computer. It's so large, so I can see it properly. But this is basically a continuation of an explanation of what you just saw. And I already explained it, so I don't have to explain it again. Okay, more and more detail from the department all the way up. Okay. So there are 3 basic types of responsibility centers, 2 that are listed here in Learning Objective 3, 1 that's covered in the next learning objective. So a cost center is listed first, and profit centers. These are the 2 centers that are included in Learning Objective 3. So a cost center is simply a part of the business that does not generate any revenue, but simply incurs costs. Okay. And so that might be, customer service departments are classic cost centers, because they're not selling anything. They're just sort of helping out and to do whatever they can for the customer, rearranging things or helping out in some other way. They're not generating any revenue, so they're not generating revenue, although they might save the customer from leaving in a huff. It's not generating any revenue, so this would be like a cost center. Okay. So the responsibility of a cost center is to keep the costs low, and so you're being evaluated on how well you controlled your cost. Okay. So a service department, a production department at the company would be prime examples of a cost center. Profit centers are different because not only do they do incur costs, because you're going to pay salespeople and do all types of other things, but they are primarily generating revenue for the company. So these are your big sales. Wherever sales are occurring, or whatever areas of your business is getting customers in the door or paying customers in the door. So your retail stores, for example, all of those, the purpose of them being there is simply to sell goods. They're strictly revenue centers, what they call a profit center. And so these are the differences here. It might be interesting to note in this case that when you go to work, depending on where you work, you're either you're either considered part of a cost center or you're considered part of a profit center. It depends. Does your work and your area generate revenue for the company directly? If so, it's a profit center. Or is it just cost? You're just taking care of other types of things. You're doing storage or whatnot. It's, cost center. An investment center we're going to look at in more detail in the next objective. Investment centers incur costs, they generate revenue, but they also have investment funds that they use to help the company grow in various ways. So we're actually going to be looking at that in significant detail in learning objective 4 here. Okay. And then they have this lovely little graphic. I kind of love it. It's page 429 here. I mean, this is like Picasso type of stuff, don't you think? I don't know. Why don't you bring this to your art class and say, what do you think? All right. So under responsibility accounting, managers are evaluated on matters that they control directly. So that's why the answer here is A. All right. So for a cost center, again, the idea here is they're not generating any revenue. They're only incurring costs for the business. Okay. And so we're still comparing the actual controllable cost with the data that we've had in a flexible budget. And so, can the manager meet the budget goals to control costs enough that makes everything work out? And so in a control center here, this is a responsibility report for the finishing department. Strictly for controllable costs, that's the difference here. Right? They can't control too much else, so that's only the controllable costs that are listed on their responsibility report. This was the budget for each of these items: indirect materials, indirect labor, utilities, and supervision. This is what actually happened for the month of January of 2017. And then the differences are noted as either favorable or unfavorable. Again, because these are all costs, if it's higher, if the actual amount is higher, that's not good. You spent more than you thought. Your expenses went up. So it's an unfavorable. But in the case here, labor, that you were expecting to spend $18,000 for labor, your indirect labor rather, you only spent $17,000, so that's less, $1,000 less of that cost. That's why it's favorable. Okay, so just sort of understanding how to do that, because this is part of your homework. You'll be looking at charts like this as part of your homework, and you'll have to determine the difference and whether that's favorable or unfavorable. So again, if it's a cost issue, this is what you want. This is what you thought you were going to spend. If you spent more than that, it's unfavorable. If you spend less, it's favorable. So here's an illustration, and this is in your book as well, page 430, I believe. So here we have, actually, no, it's not. It's actually the same illustration that was from the previous slide. Sorry. So here we have the finishing department was able to control all the manufacturing overhead costs except depreciation, property tax, and his own salary. Okay. So the difference between supervisory costs and his salary was that $4,000 difference, which was the rest of the supervisor personnel. So those costs are considered controllable by the manager. For a profit center, it's again, profit center is a little bit more complex because then they have revenue and expenses. And so we're worried simply about what's controllable in terms of the revenue and what's controllable in terms of the costs. Okay. That's what's on a responsibility accounting report. All right. So what does a manager control? Operating revenues that have earned, like sales. Right. What does a manager control? All the variable costs because they're related to sales. Okay. Uh, what about these direct and indirect fixed costs? Well, let's take a look. The direct fixed costs relate specifically to one responsibility center, one department, one division. Right? They're incurred, means they happen for the benefit of that center. They're traceable because you can trace them from one to another, from one center to another, or how they get broken down. And believe it or not, a lot of the fixed costs that are direct fixed costs are within the manager's control in a profit center. And you'll see that in a moment. The indirect fixed costs here pertain to the company's overall operating activities. They're spending X amount for the entire company on this indirect fixed cost. It's incurred for the benefit of all of the departments, all of the centers. And so because it's a common cost, that's what they call it, common costs, it applies to all the centers and thus is not controllable by the profit center manager. So what we look at in a responsibility report there is the controllable revenue and the controllable costs based on what we know. Okay. We are also going to use the cost value profit income statement format. Remember that from way back? Just last month, I think. We're going to actually create something called a controllable margin. Okay. You heard about contribution margin. This is controllable margin. Well, what is it? Well, we take the contribution margin and we deduct the controllable fixed costs. Okay. And that basically gives us any something called a controllable margin, which is the excess of the contribution margin above the controlled fixed costs. So this is something that you're going to learn here as well. So let's take a look at how this works. Now we're on page 430. This is on page 430. Okay, good to look at this. So what they have here is a responsibility report for the marine division for this company called Mantle. In this case, it's a profit center because you have sales and expenses listed. The only expenses that are listed are controllable. Okay. So they actually budgeted $1.2 million of sales for the year ending December 31st. They only were able to get up to 1,150,000, so they were 50,000 short. Now, because they didn't quite reach their budget goal here, this was an unfavorable development for sales. That has to be explained. Why were you $50,000 off from our target? That has to be explained. Then we're looking at variable costs. They have cost of goods sold. They have selling and administrative expenses. total variable costs lead to the contribution margin. So here we have a contribution margin that was $36,000 unfavorable, much less than what they had hoped for, right? $36,000 less than what they had hoped for. Then you look at the controllable fixed costs here. You have cost of goods sold and selling and administrative expenses that were within the manager's control in these areas. So we take away the total controllable fixed costs of 180, and that gave us a controllable margin of, in this case, 360. So, which again, they did not reach, right? So they unfavorable throughout. Okay, in this case. So this is what a responsibility report for a profit center would look like, and these differences would have to be explained by the manager. And of course, it's all going to start with why couldn't you sell what we wanted to sell? Because a lot of that's going to explain some of the differences here. Okay. Actually, it should explain almost all of the differences there. Okay. So in a responsibility report for a profit center, okay, controllable fixed costs are deducted from controllable margin, contribution margin, to show something called a controllable margin. And managers can be evaluated on that as well. Okay, this was a long one. And here's our do it exercise for it. This is a profit center responsibility report. The Midwest division operates at a profit center. It has sales, variable costs, controllable fixed costs, and non-controllable fixed costs listed. This is what they budgeted. This is what actually happened. And this is for the year that ended December 31st, 2017. So again, oftentimes when I give you these examples, they will actually give you the budgeted and actual amounts. Okay. And you have to figure out the differences and whether it's favorable or unfavorable to the company. So obviously, if you were expecting to sell $1.5 million and you sold $1.7 million, that's a good thing, right? $200,000 more than you expected is a favorable outcome here. Your variable costs were 700,000. You actually had 800,000. So you actually spent 100,000 more than we were expecting. So it's unfavorable. Our contribution margin clearly is favorable. No change in controllable fixed costs, which means your controllable margin was up $100,000 in a favorable way. Okay, so I'm going to stop there and bring us back. I know that was a very long portion of this chapter, but it's important to be able to read those things. I'm not going to have you actually sit and do one of those, but to read and analyze is really the critical feature here. How do you feel about that? Questions?